Credit scores or credit reports sound like some important jargon that only brokers or professionals deal with. But it can actually help if a borrower understands how this works, at least to a basic level. Credit scoring and credit reports are crucial components of a mortgage lending process. Credit scores are essentially records that state an individual's history on borrowing and translating it to how reliable they are as a borrower. For example, someone who has a record of borrowing money and paying it all back on time will have a good credit score. Someone who frequently takes short-term loans or make late payments may have a bad credit score. Someone who has never borrowed before will be starting blank. This score will ultimately affect a lender's decision to lend to you or not. It could also affect interest rate. However, before I continue, I will say that a bad credit score is not the end of the world and isn't the only thing that affects a lender's decision. In fact, there are some lenders that don't even take this into account. The credit score can be improved over time, but it is something you generally prefer to maintain and not take too lightly. Credit reports are compiled by credit reporting agencies such as Equifax, Experian, and Ilion. These agencies collect information from various sources including lenders, utility companies, and other creditors. This information is then used to generate a credit report for each borrower, which includes details about their credit history, including any defaults or missed payments. Lenders use credit scores to assess the borrower's creditworthiness and determine whether to approve a mortgage and what interest rate. The higher the credit score, the better the chances of obtaining a mortgage at a lower interest rate. There are several factors that contribute to credit scores, including payment history, credit inquiries, and type of loans. First of all, payment history is the most important factor, generally having the highest impact of a borrower's credit score. This means that making on-time payments on credit accounts is crucial for maintaining good credit and improving credit scores. Late payments or defaulting on loans all have an impact on your payment history and in turn, your credit score. Next up are credit inquiries. Whenever someone applies for credit, such as applying for a car loan, a credit card, or a mortgage, this counts as a credit inquiry. This generally doesn't have a huge impact on your score. However, depending on the number and the quality of inquiries, it can affect your overall credit score. This doesn't mean you can't ever apply for credit, just don't go overboard on it. Borrowers can obtain free copies of their credit reports from each of the major credit reporting agencies once per year. Reviewing credit reports regularly and correcting any errors can help maintain good credit and ensure that lenders have accurate information when assessing your creditworthiness. So in a nutshell, credit scores and reports show lenders the reliability of a potential borrower, but it is not the ultimate decision maker for whether a loan goes through or not. As always, this is just general information and not to be taken as advice. See a qualified mortgage broker to find out what works best for you. If you have any questions, type them in the comments below, and if you found this video helpful, don't forget to give us a thumbs up. I'm T from Loan Lounge. See you next time.